When I released a video back in January explaining the problems the banks were seeing, most people simply shrugged it off as the ramblings of a madman. But following the total failure of Silvergate, Silicon Valley and Signature banks and the near failure of First Republic and Credit Suisse, suddenly everyone is paying attention. The truth is that the banks have never been on thinner ice. We are on the precipice of a total financial collapse that will make 2008 look like a walk in the park, and the dark looming figure causing this collapse, it's not BlackRock or Blackstone, it's not JP Morgan or Morgan Sachs, it isn't even Joe Biden or Vladimir Putin, it's Jerome Powell and the Federal Reserve. They are driving the economy off a cliff, and the worst thing is they don't even have a choice anymore. Their actions are predetermined, their voices are pre-programmed, and their decisions are pre-decided. The banking sector has already crashed, you just don't know it yet. Now this started years ago, but you know the story already, so I won't waste much of your time. COVID came, lockdowns begun, the economy was stimulated with trillions of dollars of cash. We were told this wouldn't lead to inflation, but we were lied to. Inflation came and it was a problem that no one wanted to actually face, so it was simply ignored. Transitory, momentary, a non-issue. They even tried to claim it was good for us, but eventually it got to such a point that it couldn't be ignored anymore, and the Federal Reserve started to tighten monetary conditions, but it was all too late. Inflation continued far higher than we had hoped, and interest rates rose from 0% to 5% in the sharpest rate hiking process in history. And this is where problems started to emerge, because despite this effort to stop inflation, despite the Federal Reserve hiking rates 5% and removing $600 billion of liquidity from the markets, unemployment remains dangerously tight. There are still loads of jobs out there, and anyone who wants one can pretty much get one. Good news, you might say, and normally you would be right, but until employment falls, until the Fed breaks the job market, inflation is going to remain high, which means the Fed has not finished hiking. All this time, eyes have been intently watching job figures across the country. Any slight dip and markets rejoice, any slight rise and they run in fear, because they know until job numbers start to fall, inflation is not finished. This was bad enough news as it stands, because breaking the job market, which is the Fed's explicit aim at this point, will result in people losing their jobs, businesses, homes and livelihoods, and it will cause a recession. But all the while, a bigger problem was emerging from behind the shadows, and its name was the bond market. As the Fed tightened the market, bond yields started to rise, and not by a small amount. The US 10-year Treasury yield rose from 0.7% during the first lockdowns all the way up to over 4% at the end of 2022, and that means that the values of these bonds, the market prices, has absolutely tanked. TLT is an ETF that seeks to track the prices, not yields, of US Treasury bonds, and it has fallen in value by almost 40% over that same time period. What that means is that the owner of these bonds, should they ever need to sell these bonds before maturity, they're going to have to book massive losses, and these losses could take down the banks. This is exactly what happened with Silicon Valley Bank, and it's the sole reason they collapsed. They had to sell some of these bonds, they lost $1.8 billion in the process, and the rest is history. These bond values have dropped because the Fed has been tightening market conditions, and the Fed can't stop tightening market conditions unless they want the US to succumb to 1980s style destructive inflation. This whole time, millions of investors have been looking at the markets, watching the Fed hike everything, waiting for the employment market to break as a symbol that the Fed has broken the back of inflation. But every single one of those investors, they were looking in the wrong place. The banks broke before inflation did, they broke before the job market did, and suddenly everything changed. Suddenly it wasn't so clear what the Fed was going to do next. We all know what happened immediately following the crisis. One bank fell, then another, and many more would have fallen if it weren't for the bailouts that we aren't allowed to say are bailouts. And this is where things start to get really bad, because these were bailouts, and the oh so desired Federal Reserve pivot that millions of investors have been begging for over a year now may sort of be on us. Now, with the Fed back in such an uncertain place about their path forward, this means even more volatility in the markets and likely further banking collapses. Even Ken Griffin just said that US capitalism itself was breaking down before our eyes. And now JP Morgan says the S&P 500 could sink another 20% as the economy is pushed to the brink. No wonder nearly 90% of financial advisors are going big into alternative investments in just the next 2 years as a way to reduce volatility. Morgan Stanley themselves just released a report on alts, and as their graph shows, for the last 30 years a portfolio that included alternative assets would have had lower volatility and higher returns. This alt playbook is spreading rapidly according to the Financial Times, but Bank of America's investment head and BlackRock's Larry Fink have both recommended one specific high-performing alternative to rescue your cash: fine art. Don't believe me? Last year, art prices rose an average of 29%, and Masterworks returned over $25 million to their investors, including many of you. Because I've talked about Masterworks for over a year now, and literally hundreds of you have already signed up to diversify and lower your own volatility. See, Masterworks offers art from legends like Picasso, which is securitized with the SEC and broken up into shares. In December, Masterworks' last 3 exits delivered 10, 13, and 35% net returns to investors like you, even as the average 60-40 portfolio lost around 25% last year. But it's not just those 3 exits. Each of Masterworks' 11 sales to date has returned a net profit in excess of 9%, all the way up to 39% for a George Condo piece. As a result, paintings can sell out in hours, not days, but right now you can get priority access to skip the wait below. Now, as for the Federal Reserve's pivot, their decision to stop tightening conditions and start loosening them, many people are trying to work out if the pivot is on its way, but it may actually have already happened. There is more to monetary policy than just interest rates, and even though the Fed didn't hike interest rates in March, their balance sheet shows they have already started moving in the other direction. Over the duration of this crisis, the Federal Reserve increased the size of its balance sheet by over $300 billion, and they did so over a matter of just days. This is what that looks like for anyone wondering, and this means the Fed has just undone almost half a year's worth of work fighting inflation. The Fed printed $300 billion out of thin air in an act that will impact inflation in the future, no matter what Jim Cramer or your favorite Tesla investor on YouTube tells you. This could be considered a Federal Reserve pivot, as printing money in response to a banking crisis at the expense of inflation is exactly what we might expect a pivot to be. But just like how every investor was watching the job market waiting for it to break, this time everyone is watching interest rates waiting for them to fall. To clarify though, I don't think this is a pivot from the Federal Reserve, but it does show us who the Federal Reserve really is, what they really want, and what they will do when things start to get seriously bad. They were willing to print out of thin air $300 billion to save multi-billion-dollar tech companies and their millionaire founders, so who is seriously going to doubt that they will print trillions of dollars to save the bigger banks whose depositors are far more widespread and represent essentially the entire American economy? This, in my opinion, is not a pivot yet, but it does provide evidence to the idea that the pivot will come prematurely and will result in a decade of high inflation and a stagnant economy. Someone trying to argue against this idea might look back to the Bank of England during 2022. There was a bunch of turmoil as a new Prime Minister emerged and tax cuts came flooding through, and pension funds across the country were on the brink of collapse, again due to bonds of all things. And then the Bank of England stepped in to bail the system out. They didn't cut interest rates in that sense, they held firm, but they did print around £30 billion and undo the previous year's worth of disinflationary progress, just as we saw the Federal Reserve do in March. They continued to maintain high interest rates, but they were willing to risk spiking inflation in order to stop a financial crisis, and the only logical assertion to make from these two acts is that both of these central banks will do the same thing in the future. They will continue to hike interest rates most likely for now. They will continue to destabilize the banking systems, and when they finally bring the entire systems crashing down, they'll step in, play the hero, and print trillions of dollars to save the world from a depression and thus force us into massive sustained inflation. The Federal Reserve is sending our economy on a one-way trip down into hell, and they are not able to stop. Interest rates will keep on rising, and this will in turn impact bond prices negatively. That means these banks holding hundreds of billions of dollars of bonds will continue to lose their money and stack up paper losses. This graph here shows us just how monumental these losses are, with over $700 billion in losses known about from just the biggest banks, and more hidden away or unreported. And let's not forget now that it only took $1.8 billion in realized losses to take Silicon Valley Bank crashing down. Banks which choose to take risky bets about interest rates failing in the future, just like Silicon Valley Bank did, will be the first to fall, but all the other banks will suffer here too. With this much in paper losses, banks have to buy up hedges to try and counteract these losses, hedges or else they will simply collapse, and these hedges cost these banks money, especially after the stream of bank failures we've just seen in the US and the fact that the failures started to spread out into Europe as well. We know damn well banks are trying to buy up hedges to try and protect their positions as we speak. That means they will make less money in the future though, their earnings will fall, their costs will rise, and their share prices will reflect this new reality on top of the already heavy hits they took during this crisis in March. This will ripple out into the economy and be multiplied as it goes, and that's without even mentioning the basic economic hit that raising interest rates has and the economic damage done by these bank failures in the first place. Goldman Sachs within a week of this crisis lowered their GDP estimates for the United States for 2023 by 0.3%, and they are getting closer and closer to predicting an outright recession, and other banks are doing the exact same thing, estimating that the damage done to America's economy by SVB's collapse alone is probably at somewhere in the region of a couple $100 billion. The truth is, the world is in damage control mode right now, trying to convince everyone that it's all fine, there's nothing to worry about, and that there won't be any kind of financial crisis or collapse. But just looking at the facts and at the data, and we can see those people are so ridiculously wrong. I spend over 50 hours every week learning, researching, and digging into the markets, and in particular, the banks, trying to work out exactly what's going on and what is going to happen next. And I give away all of this information to you for free on YouTube, but recently, YouTube has been shadow banning my content, demonetizing it, age restricting it, and trying to stop people from learning the truth. And the only way I can ensure you get the information you need that tells the truth about the economy is through my 100% free email newsletter, Stoic Markets. You can always unsubscribe if you want, but if you want to know what's really going on, then you need to sign up with the link down below. If you want to protect your investments against inflation and maybe even a further banking crisis, then check out this video's sponsor Masterworks in the description down below. Or if you just want to hear about how Blackstone, one of the largest financial institutions in the world, is on the brink of collapse, then watch this video here.